Good afternoon, accounting 110, number 80007. Today we get into chapter 10. We're skipping chapters 8 and 9 because we hold those back until the end of this semester. They deal with payroll. So we're going to continue going through our balance sheet and our financial statements. Chapter 10 is about sales on credit and how to record them. And it's going to be about returns of goods from customers, sales discounts that people might take, and posting to the ledger, both the general ledger and a new ledger called the AR ledger, the accounts receivable subsidiary ledger. So I'm not sure who's going to join us this morning. If somebody joins us in the next minute or two, that would be great. Otherwise, I'm figuring I'm by myself today, okay? So off we go with a sharing of a screen. Share screen. Uh-oh, we have a visitor. Excellent. Hi, Jonathan.
Oh, hey, how's it going?
Pretty good. You missed my intro remarks. I
Oh,
said,
no.
I just said something like, well, you'll see what I said. I said something like, if nobody shows up, I'm just going to plow ahead. Good to have you, Jonathan. Nice job on the test, by the way.
Thank you.
Excellent work. So let's keep it up for just a few more weeks when you think about it, huh? It's amazing how fast time goes.
It really is.
All right. Okay. I just opened up the PowerPoints as you came on. All right. We already did chapter 7. Even though the schedule may say chapter 7 is what I'm supposed to talk about today, I've already done that. I'm keeping one chapter ahead deliberately. And for those of you who didn't catch those of you who are expecting to see chapter 7 today, that lecture has been archived in Canvas and on my YouTube channel. So chapter 10, dealing with cash and sales receipts, okay? Let's see what we're talking about here. What are we talking about? Merchandise sales transactions. Know what a merchandiser is. I mean, this was kind of on the first test. You buy merchandise from vendors and you sell that to customers, okay? The sale is we know what a sale is. Retailer, those are the stores. That's Kmart, that's Target, that's Macy's. Those are the stores, 7-Eleven. They sell to the final consumers, also called the end users. And the reason I'm hitting this a little bit hard is it's the final consumer who pays the sales tax. In other words, when Coca-Cola Bottling Company ships truckloads of soda to a warehouse in the middle of the United States, that wholesaler, the middle guy, he does not pay any sales tax. He sells it then to the retailer, and the retailer pays no sales tax. But when the retailer sells you and I a bottle of soda, then we pay the sales tax on that, okay? And the evidence of a sale would be a cash register tape. They're just pointing out something we probably already know. Sales ticket. You go and you write up a sales ticket. There's one clothing store in town I go to once in a while where the guy actually does write out the ticket longhand like this. Kind of old-fashioned, I think, but kind of amusing to watch him do it. Then he goes to the calculator and he figures out the sales tax and everything. Sales ticket, it just lists the goods, the price of each one. Wholesaler, like I said, that's the middleman. That's the guy who buys from the manufacturer. Wholesaler buys from the manufacturer, usually sells to retailers, usually on account. You can pretty much say always on account. They sell, on account and get paid later. And invoices are generated for each sale, and there's various distributions of that document. One goes to the customer. Well, that's the bill. One goes to accounting. We need that to record the sale, and one might get shipped with the merchandise. Wholesale transaction process, customer purchase order, and then it goes to the wholesaler, to the retailer. I don't think we need to worry about that. Here's an example of an invoice, a bill. Somebody went to Greg's Paint Company, and bought 6 gallons of glossy something and some white flat paint. Notice there's no sales tax on that. We're not worried about sales tax yet, I guess, in this chapter. Oh, a credit memo. That's simply permission to return something. There are credit memos and debit memos. And just like accounts payable, accounts receivable, it depends what side is getting charged. A credit memorandum is simply you call up a store and you say, I'm going to return this toaster I bought. I don't like it. And they say to you, that's fine. Come on, bring it back. That's a credit memo. Maybe they give you a credit memo number and you go back and when you return it, you have the credit memo number on a piece of paper. But a credit memo is simply permission to return something or to reduce the price of something. So we're going to be talking about two very specific things in this chapter: sales returns, merchandise return for refund, sales allowances, price reduction granted by the seller because of defects. You bought a toaster for $50 and for some reason you just don't like it. It doesn't seem to be toasting your bread the way you demand. So you tell the guy you're going to bring it back. The store might say, look, I don't want the toaster back either. How about I cut the price in half and you keep it? That would be an example of a sales allowance. But don't worry about the form credit memo. I think they're old fashioned. These days, you just get online and you email or text your business associate and say, I'm returning something. And they reply, no problem. That's your credit memo. All right, let's use these merchandise sales accounts, okay? Now we're getting into some new stuff, huh? Get a little more real world type activity here, which I hope is a little bit more interesting than just the debits and credits. To account for merchandise sales transactions, we're going to have some new accounts. Well, we know about sales already. Sales tax payable, that's a new one we're going to look at. Sales returns and allowances. Customer refunds payable, we're not going to go over that at all. We're not going to go over that at all. The faculty's made a decision on that we're not going to worry about these estimated refunds. And then you have sales discount. The position of these accounts are shown on the next slide. The next slide. Okay. Okay. I call your attention to the right side. You see where it says sales there? Sales. That has a credit balance, okay? And one thing you need to remember is you never debit sales. You never debit sales. Never. There's not one occasion where you would ever debit sales. But we have to reduce the sales. We have to reduce the sales. When somebody returns something, when somebody takes what's called a sales discount, and we do it through these two contra accounts. These are contra accounts: sales returns and allowances, sales discounts. When somebody returns something, we know we never debit sales. We're going to debit sales returns and allowances. If we give a discount, if we give somebody a price break, that would be sales returns and allowances. If someone takes what's called a sales discount, that is a debit to sales discounts. It's a contra account. Another way to think of sales, the number of sales is your gross sales. That's the total that you build out to customers, okay? But it does not necessarily represent the amount you are going to receive in cash from your customers, because you have to anticipate that customers are going to return things, customers are going to take a sales discount that you offer, okay? So those are contra accounts. And again, coming back to the customer refunds payable, we're not going to worry about that, okay? You're not going to get any questions like that on the test. There might be something on the homework, and we can work around that. The sales account. Well, we should know a lot of this already. It's a revenue account used to record, guess what, the sales. It's credited for the selling price of the merchandise sold. And let me emphasize that it's credited for just the selling price of the merchandise sold. It does not include any sales tax, okay? And that's an important thing to remember as we go into a few journal entries coming up. The line called sales will always be 5 units times $4 each equals $20 sales. Any sales tax on top of that does not belong on the sales line. It belongs on the sales tax payable line. So you made a sale for $100, just like we taught you in chapter 3, I guess. We debit cash to increase cash. We credit sales to increase cash. All right. If it was made on account, well, we just change cash to accounts receivable. Pretty basic stuff. Okay, let's look at a new account now. Sales tax payable. It's a liability used to record the sales tax we've collected that we owe to the State Board of Equalization, I believe, okay? Most states require retailers to collect sales tax on sales to final customers. Credited when taxes are collected on sales made, and then debited when you pay the bill, okay? So let's talk about this. You sold something that had a sales tax attached to it. So you credited sales for the 5 gallons of paint times $12 a gallon, that's $60. That's your credit to sales. Let's assume there was a 1% sales tax. That would be 60 cents that you're going to credit to accounts to accrued sales taxes payable, the sales tax payable. The $60 plus that 60 cents is going to be your debit to accounts receivable. So the accounts receivable number is going to be the higher number. The accounts receivable number is going to be the amount you expect to collect in the form of a check from your customer. And here's a quick look at a sale with sales tax. 5% sales tax. Oh, that would be nice. I wish ours was 5%. I think ours is 8.75% in Santa Barbara County, I believe. If a cash sale for $100 plus 5% sales tax is made, look what we have. Remember, the sales is always simply going to be the extension of the merchandise sold. We have to also, though, credit sales tax payable and debit cash or debit accounts receivable for 105. That liability is our company liability. It's not our money. It is not our money. It's the customer's money. But they have entrusted us to pay the $5 to the appropriate state taxing authority. That makes it our liability. So you debit cash, credit sales, and credit sales tax payable. And they're showing you the same thing here, except it's accounts receivable. So sales tax payable shouldn't be too tough. It's a liability. Excuse me 1 second. I got to clear the screen here. Get out of there, you. Okay. Now let's talk about something new. Sales returns and allowances. This is a contra revenue account. Contra revenue account. Thus, it has a debit balance. We know now that revenues, sales, income have a credit balance. So this would have to have a debit balance. And in so doing, you are reducing the net sales. The net sales defined as gross sales minus sales returns and allowances minus sales discounts. So the sales returns and allowance account is a contra to sales with a debit balance, and it's going to be showing that way on the income statement. This account is debited rather than sales so that the business can more readily keep track of this activity. If you debited sales, everything would still be okay. Your income statement would be correct, so would your other two statements, but you would be missing a piece of information that management would like to track. Oh, excuse me. Sorry about that. Businesses want to track how much of their stuff is being returned. If it's too big a number, they might realize they have a problem to address. Okay. And here we go. So take a good look at this now. This is new. A customer has just returned some goods to us. Just returned some goods. We never debit sales. And I can prove it by playing the guitar. We never debit sales. Never. What you debit is sales returns and allowances for the merchandise extension. You have to give them back the sales tax on this, which was, I guess, 5%. So we have to refund $2.30 of the sales tax payable. We don't owe that anymore. And the total becomes accounts receivable. In this case, Wilma Cuts. That is the total amount of the transaction. All right. Sometimes students, when they're doing these problems, they forget about the sales tax, and they just debit sales returns for 46 and credit AR for 46. Boy, that would be a nice scam if a business says their policy is they don't return sales tax payable. No, you got to account for it just like everything else. Sales returns and allowances. We're not going to get into the estimated sales returns and allowances. Maybe we'll teach it in the future. Right now, we don't worry about that in this course. Sales discounts. Sales discounts. Here is another contra revenue account given to customers who buy merchandise on account. And remember, everything in this chapter is pretty much on account. These are not cash sales we're talking about for the most part. Businesses offer cash discounts to encourage prompt payment. Prompt collection of accounts receivable ensures you're collecting your money more quickly. You need the money right now. Sales discounts has a debit balance because it is, again, a contra sales account or contra revenue account, and it's going to be reported on your income statement as a line called sales discounts. You look at your income statement, you are going to see a line that says sales. Next line will say less sales returns and allowances, less sales discounts. When we say sales discount, we're talking about a very specific thing. We're not talking about you walk into a store and you go to buy a computer and you expected to pay $1,000 for it, and you find out it's on sale for $800. No, that's not what we're talking about. We're talking about a very specific gap type of item. A discount we offer customers to encourage them to pay early. And it's expressed as follows: 210 net 30. See that? 210 net 30. This means you get a 2% discount if you pay in 10 days. Otherwise, you pay the net or full amount in 30 days. So let's understand that. 210 net 30. 2% discount we will give you if you pay the bill within 10 days. If you don't pay in 10 days, after that, you have to pay the whole bill in 30 days. 2% discount off sales price if paid within 10 days, total amount due within 30 days. And you could have a whole bunch of different things. You could have 110 net 30, 1% net 30, 110 net 30. Same as above, but 2%. Here's one, 2% end of month net 60. You sold something on January 15th. Well, you're giving the person 15, 16 days to pay. If they don't take advantage of that, they have to pay you in 60 days. So let's concentrate on 2% 10 net 30. That's the most common one, and the one you're going to see probably in your homework and exercises. 210 net 30, 2% discount if we pay in 10 days. Otherwise, we pay the whole amount. And by the way, if you can get someone to give you a 2% discount for just giving up the money for 20 days, that's a pretty darn good return for you. That's a discount you would be crazy not to take. So here we go. Merchandise is sold for $100 with credit terms of 210 net 30, and they received cash within the discount period. Let's look at the journal entries. First of all, they sold on account. So our first journal entry is a debit to accounts receivable and a credit to sales. We all know that, right? Debit AR, credit sales, to record a sale to customer. At that point, we don't know if the customer is going to take the discount or not. We cannot anticipate that one way or the other. We just have to wait. And it turns out the customer did pay us on time and did take the discount. So let's take a peek at that. We debit cash for $98, debit sales discount for 2, credit AR for 100. Let's look at that one more time. This customer owed us $100. Okay. They were entitled to take the $2 discount. So the cash amount is 98. How much did they owe us? $100. How much of a discount do they get? 2%, $2. The cash is 98. So this customer settled a $100 debt to us for just $98. Okay. And again, with interest rates as low as they are, you would be nuts not to take advantage of a 2% 10 discount. All right, so we've been recording these sales in our general ledger. Now we have to also record them in a subsidiary ledger. Subsidiary is a new word for you. A subsidiary means lower in rank. The general ledger is the boss. That has the detail for each account in the chart of accounts, okay? The accounts receivable ledger just shows the activity on your credit sales accounts, okay? And the detail is going to be in terms of the names of the customers. Well, looks like they're giving us some sales here. They go, what do we got? 5 sales here. Sale on account, on account, on account, on account. I can tell from experience that these are all the same. These are all sales on account to various customers that include a sales tax of, it looks like 5%, if I did that right in my head. So we had all these sales. We sold to Enrico Lorenzo, Brenda Myers, Edith Walton, Wilma Cruz, and Heidi Schweitzer. We sold all to these people. So let's see how we record these. Well, we know this already. We know that we debit. Let me start again. Let me start with the proper thought process. We know the sales number is going to be whatever the merchandise cost. So we sold $1,520 worth of merchandise. This state has a 5% sales tax. That computes to $76. So this customer must pay us $1,520 plus the 76, $1,596. Brenda Myers, she bought $440 worth of goods. The sales tax was $22. She owes us in accounts receivable $462. The receivable number and the sales number can be different depending if there is any sales tax payable or discounts flying around. Okay. And we'll just do one more. Edith Walton, we sold her $980 worth of goods, 5% discount, $49. You add it up, you get $1,029 as the amount that Edith owes us. Okay, now they're showing us how to post it to the ledger. We should already be experts in posting to the general ledger. We should be experts. Here is our general ledger. Here is the transaction. Let's go in order, top to bottom. Accounts receivable, we debited it for $1,596. We come down here, $1,596. We had a $462 sale to Brenda Myers. That comes right down here to $462. Look at the ancillary items. The sales amount, the exact amount of the merchandise we sold was $1,520 for Lorenzo. and 440 for Myers. So we come all the way down to the sales here. They go in as a credit, increasing the sales and sales tax payable. $76 and $22 go right into this liability account. This is not our money, the sales tax payable. That's money that belongs to the customers who paid us, and they are trusting us to turn that money over to the proper authorities. That's called our fiduciary duty to do the right thing for third parties. Well, take a look at your general ledger. You're going to see that the AR ledger, the accounts receivable ledger, the subsidiary ledger looks exactly the same, except it's just going to contain only the AR numbers. So let's take a peek. It's a subsidiary ledger. It contains individual accounts receivable numbers for each customer. Each customer has an account number and a summary account exists. So just like you posted to the general ledger, you're going to look at this and say it looks very familiar. And there it is. There it is. We're working with the same two people, Lorenzo and Myers. We just went through the accounts. We just went through the general ledger. This is the general ledger here, but take a look at your AR ledger. You notice you don't see the word accounts receivable. You don't see the word sales tax payable or sales or anything. What you see is the customer name. So Lorenzo, we sold him 1,596. We sold him $1,520 worth of stuff, plus the sales tax. He owes us 1,596. It gets posted as a debit, and the balance becomes that amount. Same thing with Brenda Myers. So that should not be a trouble to you. Of course, at the end of the month, the total balance, whatever the balance is in accounts receivable at month end, must equal the total balance of the AR ledger. In other words, you add up the balance to Lorenzo and Walton and Myers and all these people. Whatever number that is must equal 14,058 at this point in time. Posting to the AR ledger. Relationships to remember. Entries in the general ledger are posted to the general ledger and AR ledger. After the posting of the AR ledger and the general ledger is completed, the total of the AR ledger balance should equal the balance in accounts receivable in the general ledger. Goes without saying. Your auditor is going to come in and she's going to look at this number. She's going to see 14,058. And she's going to say, okay, who owes you that money? And then you bring out the AR ledger and you say, well, Lorenzo owes us 1,596, this person here, etc. And then the auditor can concentrate on pulling the customer information. The accounts receivable ledger is just a detailed listing of the same information that's summarized in the general ledger. They call it general for a reason. You just have one account, accounts receivable. No real detail other than the dollars going in and out. You don't know who the customers are. The detail is in the subsidiary, the AR ledger. Let's look at sales returns and allowances. Sales returns and allowances. Let me just fix something here. Sales returns and allowances. This customer, Wilma Cutts, returned some goods. She purchased $46 worth of merchandise from us. And it had a sales tax of $230. And if you look at the AR subsidiary, here is her $48.30. It's part of the $651 balance that she owes. So the journal entry is we never debit sales. We only debit the contra account called sales returns and allowances, and that's for the cost of the merchandise. We have to return her sales tax number of $2.30, and thus she no longer owes us $48.30. So just like all of this was posted to the ledger, just like all this was posted to the general ledger, the 4830, just that number, the AR number comes over to the AR ledger. In this case, as a credit because it's reducing her overall balance to us. Credit card sales. This is a good one. Credit card sales are also a contra revenue account. Did you know that? Credit card sales. Every day I buy a jug of soda at 7-Eleven and I pay $3 for the bottle. I use a credit card. That means that 7-Eleven is not going to collect $3 from Visa. Visa charges them a percentage, maybe 30 cents in this example. That is a contra account. So when you use a credit card, it's going to cost the merchant a certain amount in a credit card fee. Bank credit card sales, similar to cash sales. Credit cards are cash as far as I'm concerned. Cash is available to business as soon as the electronic deposit is made at day's end. I'm thinking now it's made almost immediately. The credit card company makes electronic deposit to merchandise's bank account for the gross amount of the credit card sales, less a fee. Fee is based on the gross amount of the sale. Okay? So merchant, that's why you see small businesses once in a while that have a sign outside their store, no credit cards accepted. They don't want to deal with the credit cards and have to pay the fees. Of course, they're limiting their amount of business they can take in, because if you're like most people, you're always bringing out the credit card rather than cash. At least I am. Bank credit card sales. Wow, let's see what we have here. We sold merchandise for $100 plus the sales tax of $5. Yeah, the credit card fee was 4% or $4.20. They're charging the fee on top of the sales tax as well. I didn't know that, but it's something I learned here. How do we process this? Well, let's divide and conquer. Let's do the first part. A sale of 100 plus sales tax of 5. We know we're going to credit sales for 100. We know we're going to credit sales tax payable for 5. So let's do that. Let's build that in right here. $105, okay? $105 is how much is to be accounted for. $105. This is what came out of our credit card, 105. How much was the fee though? $4.20. $4.20 subtracted from the 105 gives you $100.80. That's the amount that the store actually is going to get in cash. So a 4% fee. I don't know what the fees normally are, but man, it seems like a big fee to me, 4%. Easy way to handle these transactions, divide and conquer. Do the sales side first. The sale was $100. That's easy. $5. They're telling you the sales tax was a fin, and then the bank charge was 4% on the 105. That's how you get that extra 20 cents, and the difference is 180. So far we've come up with three different contra revenue accounts: sales returns and allowances for when a customer sends something back or is given a break in the price; sales discounts, which is the famous 210 net 30, perhaps. And the third contra account is this one here: credit card fees. Credit card fees. Let me take a snort here. Oh, that's good soda. Let's see what else we have in this lovely chapter here. Well, now we're talking about writing journal entries for the cash receipts. So let's see what we have here. We have received cash on account from Enrico Lorenzo paid us, Brenda Meyer paid us, Edith Walton paid us. Hey, we had cash sales. That's great. 3,600 plus sales tax. And then we had credit card sales. Credit card sales for the month of 22.5 plus tax. And the credit card fee was $900. Wow, that seems to me, it just seems like a big number, okay? That's 4% again. So let's see what we have here. I was trying to zoom. It won't let me zoom. That's okay. I'll zoom my way. Zoom, I said. Okay, at least I can read it now. Okay, keep in mind what we're looking at now is the collection of cash. We sold something for $15.96 to Lorenzo, and there was no sales tax involved, and he just paid us. Same thing with Brenda Myers and Edith Walton. It's a simple matter of just debiting cash, crediting accounts receivable, and we're done with them. Here, we made a cash sale. The sale was $3,600, and they told us the credit card fee was $1.80. I'm sorry, $1.80. I wish it was $180. The total cash that we received was $3,780. That $180 is now our responsibility. It's not our money, but we have to consider that ours and take good care of it by paying it to the state. Let's look at the last one. They gave us a whole bunch of information on this, if you remember. Bank credit card sales for the month, 22.5 plus tax, plus the credit card fee. So again, I suggest with these credit card sales, do the two credits first. Do the two credits. The merchandise was 22,500. The sales tax was 1125. So that's a total of $23,625 times whatever the rate was, 4%, gives you 900. You notice on this one, they're taking the percentage only on the sales. On the other example, they took it on the sales tax too. So I'm not sure which is correct, or what maybe it varies from state to state. So do the credits first, the sales first, then the payable. Then you say to yourself, well, we have credit card expense. I know I need to debit. And we come up with the cash amount of $22,725. We just balance out this journal entry. And they're getting into posting cash receipts. I'm not going to go over posting cash to the ledger. You know how to do that already, right? 1596 comes down to the ledger here under cash. It comes in as a debit. The 1596 comes in here as a credit. Same tack with Brenda Myers. We received cash, debit 462, and we get a credit accounts receivable 462. Take a look at your AR ledger, the detail. The AR amount of 1596 and the AR amount of 462 are the only things that are going to come over to this ledger. The only thing that hits this accounts receivable ledger is the line called accounts receivable. Let me fix this. Now it's the end of the month. we just need to prepare a simple, I don't want to use the word simple, although it is simple. We want to prepare a report called the Schedule of Accounts Receivable. And the only thing this does is list all of our customers and how much they owe us. And it's prepared to verify that the sum of the AR ledger equals the balance in the general ledger. If it doesn't, you have a real problem. An alphabetical, it says an alphabetical or numerical listing, either one's okay. You prepare it at month end. And again, the total calculated in the schedule is compared with the balance in accounts receivable in the general ledger. And it's as simple as this. At the end of April, Helen Avery owed us $2,002, Wilma $651, Heidi Schweitzer, etc. We had five customers who owed us money. They owed us a total of $14,331 in accounts receivable. If you looked at your general ledger, that is the balance you would see in the general ledger under accounts receivable, 14,331. Finding errors. Don't make errors. I can't help you with finding errors. They're telling you verify everything you did. We already talked about some of the tricks with the nine, the divisible by 9 trick, the transpositions. All right, Jonathan, your turn to talk. What do you think? Any questions?
Not so far. If I'm still being honest, I'm working on chapter 7 currently. So this is kind of out of my league right now, but for the most part, it makes sense. It kind of aligns with, with chapter 7.
Yeah. And it also aligns with earlier in the course. And when we get to chapter 11, we're going to be doing the purchasing, which is the opposite of this. Yeah, but like I said, my lecture on chapter 7 has been available for about a week, so that's up there. And the reason I'm going a little bit ahead of schedule is we can have a very good test review, which I hope was helpful on the first test. Okay.
Oh yeah, most definitely. I mean, you saw my score, right?
Yeah, no, you've done great. Well, yeah, I think you were 50-50, weren't you?
Yeah, on one, and then the second one I missed one because I misclicked. It was like what was like the first account of the 10 column worksheet, and I put for some reason I put balance sheet, but it's the trial balance, and I was annoyed.
Yeah. Well, that's easy. That's an easy mistake to make, though. You get a little mixed up on those. But okay, so we got through this, and we understand when we come back on Wednesday, we're going to jump into chapter 11. Okay.
Okay.
All right. Well, you know where to find me for tutoring or any help you might need starting tomorrow night. Okay.
All righty.
All right. We'll see you later, Jonathan. Bye bye.
All right. Thank you.
You are welcome. And that concludes today's class. Again, I'm pointing out that I am one chapter ahead of the schedule in the syllabus, and I think it's going to be good for you. It'll be good for you because it gives you extra time to catch up on things, okay? So Wednesday, we're going to talk about chapter 11. So I hope to see all of you here next week. Hopefully we draw a little bigger crowd. In the meantime, this has been Bob Smagula saying, until Wednesday. Bye-bye.